Barbara is 72 years old. She lives outside Columbus, Ohio, and spent 34 years working as a dental hygienist. She raised 2 kids, paid every bill on time, and never missed a tax filing. She did everything right. Yet when her daughter sat down to help organize her finances last Thanksgiving, they found 5 separate bills Barbara had been paying year after year that she was either entirely exempt from or drastically overpaying. Within 45 minutes, they calculated a total loss of just under $7,400 a year. That money was gone because every single person and institution collecting those bills had a direct financial incentive to stay quiet about the rules that would have saved her money. If you are over the age of 60, there is an extremely high probability that you are currently bleeding money to bills the law already explicitly says you do not owe. The amount might vary, but the drain on your accounts is real. Many people skip these relief programs because they believe they are only for low-income seniors. They assume that having a pension, some savings, or an appreciated home automatically disqualifies them. Others assume the opposite, that wealth protection strategies are reserved for the top 1% with expensive legal teams. The reality is that seniors at every income level are overpaying these bills. They are simply overpaying them in different ways. As an enrolled agent, I am federally licensed to represent taxpayers directly in front of the IRS. In my practice, the recurring tragedy is seeing honest, careful people in their 60s and 70s give their money away because no one ever told them they could stop. This is a dangerous kind of financial loss because it happens entirely in silence. There is no penalty notice, there is no alert telling you to stop paying. There is only a quiet, perpetual drain on your fixed income that will continue until you actively intervene. Bill number 1 is your federal income tax. For millions of American seniors, the correct amount of federal income tax they owe going forward is exactly 0. Yet a massive portion of the retired population continues to pay it or have it withheld from their checks, purely out of habit. The mechanism driving this shift is the senior bonus deduction. Starting with the 2025 tax year, every single American 65 or older receives an additional deduction of up to $6,000. This visual breakdown shows exactly how those numbers stack for a single filer. We start with the regular standard deduction of $15,000. Because it does not replace existing deductions, the existing senior addition of $2,000 sits right on top. Finally, the new senior bonus adds $6,000 to the pile. That brings the total deduction to $23,000 before a single dollar of federal tax is out. For a married couple where both spouses are 65 or older, the mathematics scale up. The standard deduction is $30,000. The existing senior additions are $3,200. The new bonus is $12,000. Stacked together, a married couple can shield $45,200 from federal taxation entirely. This deduction reaches well into the middle class. The full amount is available to single seniors with income up to $75,000 and married couples with income up to $150,000. It only begins to phase out above those figures, meaning comfortable retirees with pensions and investment income qualify for meaningful tax reduction. This deduction only exists for the 2025 through 2028 tax years. Failing to verify that your preparer or software applied this deduction means leaving thousands of dollars on the table that Congress explicitly set aside. Bill number 2 is the tax on your Social Security benefits. Many retirees lose money here by defaulting to extremes, either believing their benefits are always taxable or assuming they are always tax-exempt. This chart maps out how the IRS treats those benefits based on your provisional income, your adjusted gross income from other sources, plus half of your annual Social Security benefit. If you fall below the $25,000 line as a single filer or the $32,000 line as a married couple, you land squarely in the 0% tax zone. None of your Social Security is taxable. The new senior bonus deduction actively helps you here. By lowering your overall taxable income, it can pull your provisional income beneath the threshold and into the 0% zone. A common mistake occurs at sign-up. Many people fill out Form W-4V to default to automatic federal tax withholding because they fear a surprise bill in April. This results in an annual refund. Receiving a refund on Social Security withholding means you provided the government with an interest-free loan for the year. If your actual tax liability on those benefits is 0, you must file a new W-4V to eliminate that withholding and keep your money. Bill number 3 is local property tax. Relief here generally falls into 3 tiers: income-based circuit breakers for lower-income households, flat senior exemptions that remove a set amount of home value, and age-based freezes. Middle-class retirees very often overlook age-based freezes. In Texas, for example, once you turn 65, you receive a school property tax ceiling. Your school taxes are locked at the rate you paid that year, regardless of your income or how much the home appreciates. You qualify entirely because of your birthday. Your county assessor will not automatically apply these discounts on your 65th birthday. Since every dollar of property tax relief reduces local revenue, the incentive for the county is to stay quiet. You must call your county assessor directly. Ask specifically what relief programs they have for homeowners over 65, and which of those are based on age with no income requirement. This single phone call is the only way to stop paying the maximum rate on your local property taxes. Bill number 4 is your Medicare premium. There are 2 separate overpayment traps here: a universal error regarding work history and a specific lag that targets newly retired higher earners. If you paid Medicare payroll taxes for at least 10 years, 40 calendar quarters, you should be paying exactly $0 for Medicare Part A. If you are currently paying a premium for inpatient care, it is likely an administrative error regarding your work record that needs to be disputed. The second issue is the IRMAA surcharge for higher earners. This diagram illustrates the trap. Medicare calculates your current premium based on your tax return from 2 years ago. They are using your high-income working years to dictate what you owe today in retirement. The solution is Form SSA 44. Retirement is a life-changing event. Filing this form forces Medicare to recalculate your premiums based on your current, lower income rather than your past tax return. Medicare will continue using your old income level until you force them to look at the present. Failing to file this form costs unaware retirees thousands of dollars in silent, automatic deductions straight from their Social Security checks. Bill number 5 is the fee you pay just to file your taxes. Every year, seniors pay retail chains between $200 and $500 to process straightforward retirement income. The IRS-backed alternative is Tax Counseling for the Elderly, or TCE. This program, often operated through AARP TaxAid, provides free preparation by certified volunteers. You do not need to be an AARP member, you simply need to be 60 or older. If you have a complex estate, business sales, or rental properties, you should continue to pay a qualified professional. But if your income is just Social Security, pensions, and investments, you do not need to pay a retail chain for basic data entry. The TCE program is a specialized, federally backed tool built for your exact situation. Using it preserves your fixed income rather than handing it to a storefront corporation. If you have accumulated assets over your career, these next moves are for you. Many retirees remain in large, unmanageable homes because they fear that selling will trigger a devastating capital gains tax on decades of appreciation. The federal home sale exclusion shields $250,000 of gain if you are single, and $500,000 if you are married filing jointly. To qualify, you must have lived in the home as your primary residence for 2 of the last 5 years. Remember that gain is the profit, not the total sale price. You subtract what you originally paid and the cost of major improvements from the final sale price. In most cases, the exclusion covers the entire profit. Misunderstanding this rule traps seniors in maintenance-heavy homes to avoid a phantom tax bill that the IRS would never actually collect. The second bonus move focuses on a specific provision for those with standard brokerage accounts, the 0% long-term capital gains bracket. This chart shows the 2025 thresholds. If your total taxable income falls under roughly $48,350 for a single filer, or under $96,700 for a married couple, your federal tax rate on long-term gains is exactly 0%. The years immediately after retirement, but before required minimum distributions begin, create a low-income window. This is the exact time to deliberately sell off your appreciated assets to harvest those gains completely tax-free. Middle-class retirees can capture these gains without paying $1 in federal tax if they simply monitor their income thresholds and act during that early retirement window. The final move addresses charitable giving. Because most retirees take the standard deduction, their charitable gifts provide 0 tax benefit. Their donations do not reduce their taxes because they are already at the deduction floor. This flowchart demonstrates the Qualified Charitable Distribution, or QCD. If you are 70 and a half or older, you can instruct your IRA custodian to send money directly to a charity. This move bypasses the taxable income funnel entirely. The IRS never sees it. Keeping this money out of your taxable income is more effective than a deduction. It keeps your provisional income low, which protects your Social Security and helps you avoid Medicare IRMAA surcharges. Additionally, once you reach age 73, a QCD satisfies your required minimum distributions. You avoid the tax on the withdrawal and support your charity simultaneously. Every strategy covered today, the deductions, the exclusions, and the exemptions, is real and legal. However, none of them will trigger automatically. The reality underlying these rules is simple. The institutions collecting your money benefit from your silence. They rely on the assumption that these programs are meant for someone else. You now know the rules, and you know they apply to you. Review these bills before the next filing season, and please, send this video to the other seniors in your life. Their awareness is the only thing that will stop the quiet drain on their nest eggs.